Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A tech bloodbath rocks Wall Street as the Nasdaq plunges over 2%, signaling the AI bubble may be bursting. But while giants stumble, small caps are quietly surging. Is this a rotation or a market-wide reckoning? Second, constitutional crisis looms. A Supreme Court showdown threatens a $750 billion fiscal bomb, putting trillions in tariffs at risk. A single ruling could drain the US Treasury overnight. Is this a battle over presidential power or the hidden trigger for the next financial crisis? Finally, the 92% illusion. AI drives nearly all US growth, but its funding reveals a shocking truth. The entire boom is bankrolled by the ad empires of Google and Meta. What happens when the AI they're building destroys the very advertising model that funds it? Brace yourselves. Markets are on edge today, and it's not for the faint-hearted. The tech-heavy Nasdaq is struggling to find its footing after a 2.04% drop, and I'm telling you, this is a wake-up call. The AI valuation bubble is bursting, and if you're still clinging to those high-flying tech stocks, it's time to make a move. The S&P 500 managed a meager 0.4% gain yesterday. But don't be fooled, this is not the time for complacency. The Dow's 0.5% rise signals a shift as investors rotate out of tech and into more stable sectors like financials and industrials. The real story here is the Russell 2000 jumping 1.5% and showing that small caps are back in favour as the market adjusts to a new reality. Let's dig into the heart of the issue. AI stocks are in freefall. And this isn't a drill. Companies like Palantir, trading at a mind-boggling 700 times forward earnings, are dragging down the sector despite reporting stellar operational performance. Goldman Sachs and Morgan Stanley's dire warnings about AI valuations are triggering a mass exodus. This isn't just about one company, it's a systemic reckoning that could lead to a 10 to 20% correction across the board. Why should you care? Because this isn't just about inflated valuations, it's about the broader economic picture. The ADP report showed a mixed bag with large companies adding jobs while small firms struggled, reflecting a bifurcated labour market. Inflation remains a thorn in the side with the ISM Services Prices Index hitting a 3-year high of 70%. This suggests that while the Fed is playing it cautious, the market's pricing in a December rate cut with only a 67.3% probability, down from 90%. So, what does this mean for your portfolio? Listen to me, it's time to act. Rotate out of overpriced tech stocks and into sectors with solid fundamentals. Financials are benefiting from a higher for longer rate environment, and consumer staples are looking attractive with their defensive characteristics and steady dividends. The XLF Financials ETF is up, driven by expanding net interest margins, while the XLP Consumer Staples ETF provides a safe haven with its 2 to 3% yields. Now, let's talk specifics. Good advice makes you rich. Bad advice costs you a fortune. Listen to me, short term, cut your losses on Palantir and Nvidia. Reduce your tech exposure by 15 to 25% and shift that capital into financials and healthcare, targeting a 3 to 5% increase in allocation. ETFs like XLF and XLV are your friends here. Medium term, watch the Nasdaq's 19,000 support level. If it breaks, it's a sell signal for growth stocks. And for those holding cash, maintain a 10 to 15% reserve to capitalize on buying opportunities if the S&P 500 dips below 6,650. For risk management, keep an eye on the 10-year Treasury yield. If it breaches 4.5%, defensive moves are in order. Advanced investors should look into protective puts or inverse ETFs like SQQQ to hedge against downside risk. In sector news, financials and consumer staples are the winners today. JP Morgan and Goldman Sachs are up on strong earnings, while McDonald's continues to defy gravity with solid sales growth. On the flip side, tech giants like Apple and Nvidia are feeling the heat as valuation pressures mount. If you're contrarian, look at sectors like energy, where companies are undervalued and poised for a rebound. Remember, the clock is ticking. The government shutdown and Fed's next move are looming large. Stay alert for CPI and PCE data releases later this month. These will be crucial in shaping market sentiment. Now let's take a closer look at the specific stories driving today's action. The United States government might have to refund over $750 billion. That's the staggering figure on the table as the Supreme Court signals deep skepticism over aggressive tariffs imposed by former President Donald Trump. A refund of this size would be a massive fiscal shock. The government's main checking account at the Fed, called the Treasury General Account, or TGA, currently holds less than this amount. A sudden $750 billion outflow would essentially drain it, forcing the Treasury to immediately borrow huge sums of money. This sudden surge in borrowing could push short-term interest rates higher, affecting everything from car loans to corporate debt. The core question tearing through the nation's highest court is this: are these tariffs a tool of foreign policy, or are they simply taxes that only Congress has the power to create? Justice Sonia Sotomayor didn't mince words, telling the administration's lawyer directly, "You say tariffs are not taxes, but that's exactly what they are." At the heart of the debate is a fundamental principle of the US Constitution. Article 1, Section 8, the Commerce Clause, explicitly gives Congress, not the President, the power to regulate commerce with foreign nations and to lay and collect taxes, duties, imposts, and excises. The administration argues it's using emergency powers, but the court seems to be saying that if it looks like a tax and acts like a tax, well, it can only be created by Congress. The numbers are jaw-dropping. In just the second half of fiscal year 2025, the government collected $151 billion from these duties, a nearly 300% increase from the year before. If allowed to stand, these tariffs are projected to generate an extra $3 trillion for the United States by 2035. But this showdown is about more than just money. Conservative Justice Neil Gorsuch framed it as a constitutional crisis, warning of a one-way ratchet toward the gradual but continual accretion of power in the executive branch and away from the people's elected representatives. However, if you zoom out, you'll see another layer of strategy at play here. This case is a major test of a 1977 law called the International Emergency Economic Powers Act, or IEEPA. It was designed for things like sanctions against terrorist groups. The administration has used this act to justify these broad tariffs, effectively turning it into a powerful tool to bypass Congress and even the WTO on trade policy. If the court upholds this use of IEEPA, it could set a precedent, making it easier for future presidents to unilaterally impose tariffs. This is exactly why Justice Gorsuch is so concerned. And the argument against the policy gets even more specific. Lawyers challenging it pointed out that a 39% tariff was imposed on Switzerland, a US ally with whom the country runs a trade surplus, undermining the administration's entire stated rationale. While business owners argue that American consumers are footing the bill, former President Trump has called the case literally life or death for our country. And it's not just talk from business owners. Research from institutions like the National Bureau of Economic Research found that the costs of these tariffs will almost fully pass through to US importers, who then pass them on to consumers. This brings up a critical question. If these tariffs are reversed, will companies pass the savings back to consumers by lowering prices, or will they just enjoy fatter profit margins? The answer will reveal a lot about corporate pricing power in today's economy. A reversal would also create clear winners like importers and retailers, and losers like domestic producers who would suddenly face intense foreign competition. The battle lines are drawn, pitting executive authority against Congress, with a potential $3 trillion revenue stream hanging in the balance. From one potential fiscal bomb threatening to drain the US Treasury, let's turn to the force that's single-handedly propping up the entire economy, at least on paper. Let's start with a single statistic that might just change your entire perspective on this. A Harvard economist estimates that an astonishing 92% of US GDP growth in the first half of 2025 was driven by one thing: investment in artificial intelligence. So what does that actually mean? Well, GDP is the total value of everything a country produces, and it's made up of consumption, investment, government spending, and net exports. That 92% figure comes from the investment part. So the thing is, this massive contribution from AI is masking weakness in other parts of the economy, creating a fragile expansion that depends entirely on one sector. If AI spending slows down, it could trigger a sharp and unexpected GDP downturn. As we've discussed, multi-year capital expenditure cycles tend to keep rolling even with policy uncertainty, and this is the clearest confirmation yet. Hundreds of billions of dollars are fueling an AI arms race. But the real story isn't just the spending, it's where the money is coming from. The entire boom is being bankrolled by the advertising empires of Google, Meta, and Amazon. Believe it or not, this link is incredibly direct. Digital advertising revenue growth has become what economists call a times leading indicator, times for AI capital expenditure. When ad revenues go up, we can expect AI investment to follow. For example, in Q2 2025, Meta reported a 21% year-over-year ad revenue increase, while Alphabet's grew 13%. This is the fuel for the entire AI ecosystem. This is where the situation takes a more complex turn. The very AI they are building has the potential to completely destroy the business model that's funding it. AI is set to fundamentally change how people search and shop, threatening the core of Google's search ads, Amazon's retail media, and Meta's engagement-based revenue. And this isn't some distant threat, it's already happening. Recent data shows Google's search market share dipped below 90% for the first time in nearly a decade, coinciding with the rise of AI search tools. This creates a potential value trap in some of the market's largest stocks. Their massive market cap might just be a times lagging indicator, times of past success. When OpenAI launched its AI browser, Alphabet's stock dropped over 7%, wiping out $150 billion in value in a single day. That shows just how nervous investors are. OpenAI CEO Sam Altman has even thrown down the gauntlet, calling ad-driven feeds the first at-scale misaligned AIs, explicitly stating his goal is to disrupt his rivals' profits. This isn't just a race to innovate, it's a high-stakes defensive war. The tech giants are forced to invest billions to build the technology that could make them obsolete, just to stop a competitor from doing it first. The situation presents a fascinating duality. On one side, you have the American private sector ad profit-fueled model. On the other, China is pursuing a completely different state-directed path with its new infrastructure initiative, pouring trillions into AI and 5G to enhance national competitiveness. The outcome of this competition will heavily influence global tech standards and the strategic balance of economic power. This reveals the ultimate risk hiding in plain sight. These ad models support a far greater portion of the public markets than most realize. If AI does break the ad-based economy that is funding its own rise, the resulting shock to the global markets would be far greater than most could imagine. The key things to watch going forward will be the quarterly ad revenue reports from the tech giants and the user adoption rates of new AI-powered search tools. These will be the early warning signs of any major shift.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.